Hi everyone, I'm Debbie Roberts, owner and financial advisor at Property Apprentice. Welcome back to the Week in Review. In this episode, I'll unpack the sudden surge in tourism and migration that has the broader economy starting to hum, why the Reserve Bank is holding the official cash rate steady at 2.25%, and a massive shake-up to Auckland's long-term housing targets. Plus, we have some fantastic news for first-home buyers, with ASB officially opening its doors to the 5% deposit scheme. Plenty to cover, so let's get stuck into it. Topics for this week from New Zealand Advisor on the 13th of February, migration and tourism rebound sets stage for housing revival. Topic number 2 from Good Returns on the 19th of Feb, ASB joins low deposit Kāinga Ora scheme with some benefits. Topic number 3 from One Roof on the 18th of February from Tony Alexander, what the OCR Pause and the bank's shock emission means for mortgages. Topic number 4 from RNZ on the 19th of February, government listened to Aucklanders by weakening housing intensification rules, Character Coalition says. Topic number 5 from Cotality on the 18th of February, monthly housing chart pack for February 2026. So first up for this week in review, we've got the New Zealand Advisor article from the 13th of February, migration and tourism rebound set stage for housing revival. According to recent Stats New Zealand data, the New Zealand economy is starting to hum, fueled by a late 2025 turnaround in migration and a robust recovery in tourism. While overall net migration for the year was historically low, December recorded the strongest monthly net inflow since early 2024. With Kiwi departures cooling and non-resident arrivals rising, this strengthening immigration is expected to ease the drag on domestic demand and the housing market. Tourism has also bounced back, with overseas visitor arrivals surpassing 3.5 million for the year. That's reaching 90% of pre-pandemic levels. What does this mean for borrowers? A firmer economy points to firmer interest rates. ASB economists expect a gradual series of official cash rate hikes starting late this year, potentially peaking at 3.25% in the second half of 2027. Mortgage advisors are urging clients to stress test for higher repayments as improving economic growth takes centre stage over rate cuts. My thoughts on this are fix for as long as you can, but still make sure that it's financially viable for you. And also, obviously, you wouldn't want to fix for a long term if you were planning on selling in the short to medium term. Also important to point out that even though we've had an increase in net migration, we're still at levels about half of the long-term average. So we're a long way off from having booming migration back into New Zealand, but it is certainly going to help fill some jobs and put some, bit of more demand on the rental market and the property market in general. And topic number 2 from Good Returns on the 19th of February, ASB joins the low deposit Kāinga Ora scheme with some benefits. Great news for first home buyers. ASB has officially joined the Kāinga Ora first home loan scheme. This initiative allows buyers, eligible buyers, who can afford regular repayments but struggle to save a 20% deposit, to purchase a home with just 5% deposit. Eligible buyers who've contributed to KiwiSaver for at least 3 years can withdraw their savings for the deposit and will also qualify for ASB's first home buyer cashback offer of at least $5,000 for mortgages over $200,000. Borrowers using the scheme do need to pay a one-off lender's mortgage insurance fee of 1.2% of the total loan. However, ASB brings a unique advantage to the table. Unlike other banks, they'll factor in the rental income from 2 boarders. Not all banks will accept boarder income, or at least won't accept 2 boarder incomes. Mortgage advisors note that this could increase a low deposit borrower's purchasing power by up to $100,000. My advice is talk to your mortgage advisor who's got access to a range of different lenders, because there are other lenders that are available to be used with this low deposit Kāinga Ora scheme. And certain criteria applies. So, you need to have below a certain income level to qualify for that. Topic number 3 from One Roof on the 18th of February from Tony Alexander, what the OCR pause and the bank's shock emission means for mortgages. The Reserve Bank of New Zealand, RBNZ, and its new governor have unanimously voted to keep the official cash rate, the OCR, steady at 2.25%. No surprises to anyone, I'm sure, right where it's sat since November last year. Despite global economic uncertainty, the committee's confident that inflation will comfortably return to the 1 to 3% target band. They're currently balancing the reality of high unemployment and sluggish consumer spending against the risk of businesses aggressively raising prices to rebuild their margins. Even though the RBNZ underestimated inflation by 0.4%, they didn't give in to market predictions of a rate hike later this year. Instead, they're sticking to their timeline of a first increase in mid-2027 with their projections. Economist commentator Tony Alexander notes that the RBNZ appears to be looking for excuses not to tighten. He suggests the committee is stuck in a historical mindset of acting too late and too much when it comes to both tightening and easing. Recent statistics back up a cautious approach. National house prices dropped 0.6% in January, following a 0.7% fall in December, while core retail spending on credit cards shrank by 1%. Alexander expects it'll be a few months before any surprisingly strong economic data emerges. The RBNZ stance has caused wholesale borrowing costs to dip slightly, taking the immediate pressure off banks to further increase fixed mortgage rates in the short term. With the urgency to hedge against rising rates cooling, Alexander expects most borrowers will continue to fix for 1 or 2 years. However, he notes that he would personally opt for a 3-year fixed term right now as a safeguard against businesses unexpectedly driving up prices. So my thoughts on this are, it is important to understand that the official cash rate really only affects the floating interest rates in very short term. It's the wholesale borrowing costs that affect the longer term interest rates. And the wholesale borrowing costs are determined by what the lenders think the Reserve Bank might do in 1, 2, 3, 4, 5 years from now. And so long term, interest rates could continue to increase, but this announcement has certainly reduced the risk of the shorter term interest rates increasing at a faster rate. So it's going to be interesting to continue to watch this space, in my opinion. I think it has certainly removed the risk of seeing more increases in current interest rates in the short term. Also, some good news is that moving forward, the Reserve Bank is going to be able to look at monthly data for some of the things rather than quarterly. So that's going to help give them confidence to make decisions a little bit sooner rather than later. And that was announced in the budget from the government as well. So that's going to really help. Now, if you'd like to learn more about the property market and how to succeed with property investing, join me for one of our free events that we hold regularly online. As a financial advisor and experienced investor, I'll show you how to navigate the current market with confidence and make the right decision for you and your family. We're live, online, and independent. We don't sell property, so no conflict of interest there. Go to Property Apprentice to secure your free spot for one of those live online training sessions. And feel free to ask questions in there. I'll answer as many as I can. Topic number 4 from RNZ on the 19th of February. Government listened to Aucklanders by weakening housing intensification rules, Character Coalition says. Cabinet has agreed to lower Auckland's long-term housing target from 2 million to at least 1.6 million homes. This is a step back from the highly debated Plan Change 120, which was designed to zone for 30 years of growth. Advocates from the Character Coalition and Devonport Historic Society welcomed the change, calling the original target unrealistic. They criticised central government for imposing the rules, noting it threatened character neighbourhoods and risked putting high-rises in suburbs like Howick, Belmont and Milford. While the council will have more say over which areas avoid intensification, heritage advocates remain worried about character homes near the city's rail network, specifically around the Mangawhau, Kingsland and Morningside stations. Auckland Mayor Wayne Brown fired a warning shot at central government, stating he will not be dictated to by Cabinet. While ACT leader David Seymour noted the government is waiting on a council summary before legislating the changes, Brown explicitly stated that the council's not seeking cabinet approval and would stick with the $2 million if forced. Brown dismissed the uproar, emphasising that the $2 million figure was always just a long-term concept. He added that if the reduced number calms down some worried elderly residents in Epsom, then that's done its job. And I tend to agree with him there. You know, the 2 million figure for new housing, that's basically just to stop people from reaching thresholds. You know, it doesn't mean that 2 million are going to get built. So it just gives developers confidence to make longer term plans without having to run into a situation where the council can't approve any further. So yeah, just because it had a 2 million figure didn't mean that 2 million properties were going to get built. Topic number 5 from Cotality on the 18th of February, monthly housing chart pack for February 2026. The New Zealand property market kicked off 2026 cautiously. National median property values fell a modest 0.3% over the 3 months to January, leaving prices 17.5% below the 2022 peak. Auckland and Wellington continue to underperform, while markets such as Dunedin, Invercargill and parts of Canterbury are showing more resilience. January sales dropped 10.7% year on year. However, Cotality chief property economist Kelvin Davidson believes this is just a blip caused by deals being rushed into a strong December. When looking at December and January together, the upward sales trend remains intact. First-time buyers saw their market share dip to 26.2% in January, but the overall volume of deals remained strong. Mortgaged investors are holding steady thanks to lower interest rates, and there are early hints of movers, in other words, relocating owner-occupiers, people either upsizing or downsizing, gaining the confidence to trade up or trade down. The rental market is softening as net migration falls and housing supply remains high. National median rents dipped 0.8% year on year, with Wellington experiencing a massive 10% drop. Auckland, Hamilton and Tauranga also saw declines, while Christchurch and Dunedin held up better. With affordability reaching its best level in years, easing mortgage rates and listings drifting lower, the market is finding its footing. Davidson expects a year of gradual modest growth and measured recovery rather than a sharp rebound. My thoughts on this are, I think that with rents coming down, that has got to be good news for tenants. Rent is a lot more affordable than it's been for a long time. And having a bit of stability in the rental market is good for everyone. It's good for landlords and it's good for tenants. And let's face it, there's a lot more tenants than landlords in the New Zealand property market. So I think this is good news for renters all around. And also with house prices coming down, it doesn't necessarily mean that the cash flow on properties has got worse, because with house prices coming down and rents dipping, if you're looking at purchasing in the current market, these are the highest yields we've seen in a long time. Yes, it could affect people who already own some rental properties, but, long-term tenants, look after them and they will look after your property and stay longer term, especially, in my opinion, with the new PEP bond rules and things like that. It helps tenants have confidence that they're not going to get turfed out of a house sooner rather than later. So what's the verdict for the week? We're seeing a market that's finding its footing with cautious optimism. From the Reserve Bank holding steady on interest rates to rents resetting and first-time buyer schemes expanding, there are clear opportunities for those paying attention. First clue should be when banks start relaxing their lending rules, it's because they've got confidence in the property market. So, that's a signal to everyone, in my opinion. And with the economy starting to show signs of recovery, starting to hum, as they say, navigating this recovery does take careful planning. If you're looking at buying your first home using the new 5% deposit schemes, expanding your portfolio, or just trying to figure out how to structure your mortgage, you need a plan based on data, not on headlines. Come along to one of our free events called How to Succeed with Property Investing. and I'll give you some insights that could help you on your journey. Whether you're an experienced investor or just getting started, this free session will give you some key tools and insights to make more confident, informed decisions. So register today and take that next step towards achieving your financial success. At the end of the free events, I'll also tell you more about how we could help you as a client to reach your long-term financial goals. If you'd like to find out more about how we can help you, go to propertyapprentice.co.nz today and register for one of our upcoming events. And you'll also get the opportunity to have a phone call or meeting with my husband, Paul Roberts, through our website, propertyapprentice.co.nz. But I do encourage you to come along to one of the free events as a first stop, because that could answer a lot of your questions there. I look forward to seeing you. And for those of you that are already clients, you know you can call your coach whenever you like, whenever you got questions. Thanks for listening. Hey there, want to stay on top of the latest property news and trends? Subscribe to the Property Apprentice podcast for weekly updates that will help you to navigate the market like a pro. We cover everything from insider tips to expert interviews, so you'll always be in the know. And don't forget to ring the bell and hit that subscribe button here on our YouTube channel for even more helpful content to boost your property journey. Check out the link in the description to subscribe to the podcast, and we'll see you in the next episode. Happy investing.